Earlier today, I tried to go live twice. For some reason, people couldn't hear me, but I think I figured it out. So we're going to try it again. Going live. So go ahead and just share this video when you go on here. We're going to get started in a few minutes. We back at it. We back at it. I just couldn't let the day go by without doing this live. They tried to stop me earlier. Can't let it happen. Jesse, you with me? Appreciate you being on. Thank you for waiting. I think I figured it out now. We shouldn't have no issues. Go ahead and share this video before we get started. Unfortunately, I got to repeat myself and do my little introduction again. And so I'm gonna just go ahead and just start it off. You know, for those, this is your first time getting on, this is Crowd Wall Street. And for those who don't know who and what Crowd Wall Street is, it's a Black-owned crowdfunding platform. We recently launched late August. We are in what's called phase 1. And our phase 1 is pretty much rewards based, similar to Kickstarter. If you guys heard of Kickstarter, we have a reward based offering right now. We are planning right now for our phase 2, which is offering equity and real estate opportunities. We are also in the process of partnering up with organizations in Africa as well, and bridging that gap where not only helping those individuals in Africa raise capital, but also giving them the opportunity to invest here in the US. And we have the opportunity to invest in projects in Africa. Right now, Africa has a lot going on, especially in Ghana. They have a lot of investment opportunities. So we're pretty much trying to help create and bridge the gap where now we're able to, you know, pour funds back in Africa as well. So again, Crowd Wall Street, crowdfunding platform. If you haven't joined the group yet, go ahead and join the group. Share this video every Wednesday for the most part. I won't say every Wednesday, but for the most part, every Wednesday we do a live interview. It's called Crowd Wall Street Entrepreneurs. And basically the whole idea behind that is a lot of times we see on Facebook and Instagram the success of people. You know, they show pictures, they show their accomplishments. You see them buying houses, starting businesses, riding in nice cars with money. But a lot of times you don't see what really goes on behind the scenes. You don't really see the struggles and obstacles that people face in entrepreneurship on their journey. So the whole purpose of our Wednesday night lives is to actually interview entrepreneurs where they share their story. They share the challenges and the obstacles and the setbacks that they experience. You know, there have been times that people wanted to quit. And it's just refreshing to hear, that you're not the only one that's going through that. So when you hear other people's story, it brings enlightenment to your world to let you know, especially those who are in entrepreneurship, to know that you're not on this road alone. And so to hear the people who overcome their obstacles and end up creating this success for themselves is kind of motivating to keep you pushing forward. So that goes on every Wednesday. If you haven't seen none of our Wednesday night interviews, you can check them out on our YouTube channel. The YouTube channel is, you can just type in Crowd Wall Street Entrepreneurs. Make sure you subscribe and you can catch up on all the videos that we did. Today, Sundays, every Sunday we do trainings. When we first started Crowd Wall Street, our primary goal was education. We want to make sure we educate our people because unfortunately, there are other people that's out there, especially African Americans, Black folks, that have these companies and businesses. And number one, they have the lack of communication. And number two, they're doing fraud, just being honest and being transparent. So it makes it harder for people like me and my team to present opportunities or to, create opportunities for our people. And there's a trust factor there because so many people being burnt for so many years. And so when we started Crowd Wall Street, that was one of our main goals, to educate and be to educate and be transparent to our people. That way, you guys will understand what we're doing. We're not trying to hoodwink nobody or anything to that nature. So Sundays is we do live trainings like I'm getting ready to do tonight. We do live trainings where we educate you guys on crowdfunding. We educate you guys on investing. We show you guys how to invest in startups, real estate, and a lot of things. Understanding terminologies, because in maybe I would say in the next couple of weeks we're going to start getting companies that's going to be raising capital. And if you're an aspiring entrepreneur and you've been looking to raise capital through crowdfunding, just shoot me or one of my teams a text or an inbox, and we'll be happy to have that conversation with you. So enough of that spiel. Today we're going to talk about angel investing. How to become an angel investor. So I have a presentation I'm going to show you. We're going to try this. So when I have the PowerPoint up, y'all tell me if y'all can hear me. Give me 1 second. All right, so give me a thumbs up if you guys can hear me. All right, Jassy, I got my thumbs up. Jassy is on now, Jassy. I got my thumbs up. It's time to go. It's time to go. All right, so here it is. I promise I won't be long. How to become an angel investor. So this here is basically you're going to learn how you can invest in early stage startups. Now, I may do a part 2 because taking into effect that some people are not familiar with this space. Many people heard about investing in real estate, but not that many people heard about being an angel investor or even investing in startups or early stage companies. So this is really a way where I'm going to open your mind up and open your brain to understanding how this thing works. So first thing first, what is an angel investor? An angel investor is an early investor in a company who gives cash to a startup in order to help it jumpstart. So we all know, like when we start our business, especially in the early stages, the first thing we need is funding, right? We need capital, and in most cases, we end up going to banks, or if we have a rich auntie or a mom or my dad or our dad, we go to these individuals first to get money. And if all these 3 fail, we end up probably using our credit card, or we just bootstrap it to just try to make the best of it, right? But a lot of times, well, most of us don't know that we have other opportunities where we can find what's called angel investors. Angel investors are wealthy in the past. They were wealthy individuals who find startups and find, companies that's just getting started, and they invest inside these companies. Now, when an angel investor invests in this company, they receive what's called a convertible debt or equity. Convertible debt, also known as convertible note. Many of you guys may not heard of it, but what it is it's a debt instrument, like a loan that let's say, for example, can go for 3 years, right? You have this debt that expires in 3 years. So the investor has an option. When this debt expires on that 3rd year, based on where your company is located at, if he feels confident that the company is going to continue to grow and make a profit or generate revenue, what happens is he's able or she's able to convert that debt into equity. On the flip side of that, he may not be too confident, or he may not want equity of the company, so he just leave it as a debt where you just have to pay that money back. So that's the difference. So convertible debt is basically giving that investor the option to either turn that debt into equity or just keep it as a debt where you have to pay that debt back with interest. So again, like I said, an angel investor would be the first person to invest in a new idea. So there's two types. Even though in today's world, angel investors, they invest in multiple rounds, which we'll go over in the next few slides. But there's two main types of angel investors. You have what's called pre-seed investor, and you have what's called seed investor. Pre-seed investor are those companies that's really getting started. Like they have no revenue, they have no traction, they have no social proof, and they're really just trying to get the ball rolling. And what happens is these angel investors may believe in, number one, the founder, and they may believe in the idea. So these are individuals that invest in the pre-seed stage. Then you have what's called the seed stage. So the seed stage is obviously the company that still may not generate revenue, but they have what's called a product market fit. That means they have some form of traction. That means they have some form of community behind the company where, for example, product market fit is basically if I'm coming out with a new soap, right? The soap that helps clear acne, right? And I'm just getting started. The first thing I'm gonna do is go ahead and do a beta test. I'm gonna get a group of individuals who have acne problems, give them my soap, and then they get back to me 15, 30 days later and finding out that it clears up their face, it clears up their acne. Guess what? I have a product market fit. I know it works. Now I'm building on that. So now I have something to go to an investor and say, hey, I have this product. I tested it. It works. These are the testimonies. Now I'm looking to raise $100,000 because I need inventory. I want to set up a shop. I want to do this. I want to do that. That's what a seed investor is. Now they're watering that seed for it to grow. So these are the two different stages where angel investors will invest at. Why is this important? Because as an entrepreneur, when raising capital, you need to know where you're at in your business. And when you understand where you fall at in your business, you will know what type of investors to look for. And I have seen this plenty of times on Facebook where people just post like, I'm looking for $100,000. I got this great idea. I'm looking for $100,000. That is wrong. That's not how you find investors at all. So it's different ways to pitch your business. And one of them is understanding what type of investor you're looking for. So tonight, we're talking about angel investor. Next week, we're going to talk about VCs and private equity and hedge funds. So yeah. So here, we're going to spend a couple of minutes here on this page. It may look confusing. I'm going to break it down for you. Many of us understand this is how funding rounds work. And a lot of us don't even know all this goes on. And where we're focused at, if you can see my mouse, a lot of us are familiar with the IPO, which is the public stocks. So if you purchase stocks like Amazon, Tesla, Uber, Walmart, these are where we're buying stocks at up here. The public equity, the IPO. And a lot of us don't realize all this down here that goes on before a company even goes public. This is what you call private equity. This is where you invest in private companies before a company actually goes public, right? So starting at the very bottom, at the very beginning, what we just went over was called a pre-seed funding. The investors at that level, you have what's called FFF. FFF is your friends, family, and fools. The reason we say fools is these people who just got money and they just invest in the business because they just got the money and don't even know what they're investing in. So they just believe in you and they just give you, you got your grandmas and your granddads, they just believe in their baby. And I'm going to give you, this $20,000 because I believe in you, right? So we have the friends, family, and fools. You have the angel investors, which I just went over. Then you have what's called accelerators and incubators. Now, the accelerators and incubators are pretty much organizations that are hands-on. They help you jumpstart your business. They have a team of experts and people with experience, and they pretty much help hold your hand as as you're going through like a course. And once you graduate, you actually get funded as well. But also these companies, these organizations also get equity in your company as well. So once you go through your pre-seed stage and you figure out that you have a product market fit, you have some type of traction, then you move up to what's called seed funding, which we went over. And as you can see, you have kind of the similar or same investors at that stage. What's added here is VCs. Now you have some VCs that invest at the seed stage. And then and understand this, each investor plays a role at each funding. And that's another thing you got to consider. If you're looking to raise capital and you're looking to go public or you're looking to be acquired, things of that nature, it's important to know what type of investor to look for, because each investor should be taking your business to the next level. So once you move up to the next level, and I really haven't dig deep in this because I don't want to confuse somebody, because a lot of this really depend on revenue streams and customers acquisitions. And I don't want to throw all these things at you to confuse you. So again, I might do a part 2, but right now I'm just giving you the basics. So let's just say you have your seed funding, you got, maybe $100,000, $600,000 or $1 million. And now you go to the next level. And see, as you move up, you go to Series A, Series B, Series C, and then eventually Series C, and they even have Series D and Series E. But at this level, before you go public, now you're dealing with private equity and hedge funds, right? So the whole objective primarily with private equity is to take your company public. And if you've been following, companies that goes public, most of these companies that go public have to be at $1 billion valuation. And as you can see over here, as the company grows, the valuation goes higher. As the company grows, it takes time. And I'm gonna explain all this too. So that's why when a company goes public, the valuation, like these companies be worth $1 billion, $2 billion, $3 billion, because of the valuation of these companies, because we don't see all this that goes on. We only see or hear about companies going public. Now, here's the thing I want you guys to understand. Listen to me clearly. When you invest in stocks, understand who's really winning the game here. The angel investors, the incubators, the VCs, they're the ones that's actually winning. We're actually getting the end of the stick when we invest in stocks, because in most cases, and I say in most cases, when you invest in stocks, these stocks only can go so high because they already value at $1 billion. They may start off at 14, 15, or sometimes $20, but they can only go so high. That's why you have to buy a lot of shares and things of that nature. But the angel investors, the ones that's investing in these companies early on, they're seeing a 700% or even 1,000% return on their money. And why is this important to know? Because the average person did not have the opportunity to invest at the early stages, like pre-seed and seed funding. Those were only saved for wealthy individuals. And I get it, because at the end of the day, the people with the money have more risk tolerance. They're able to lose, $25,000, $50,000. The average person can't afford to lose $100, right? So that's why they really didn't allow the average person to invest in early stage startups, because it's a high risk, very high risk asset class. But now, which matter of fact, we'll go over that in a minute, but give you a prime example. Many of us are familiar with Facebook, right? We all on Facebook. We on Facebook right now, right? And many of you probably own Facebook stocks, right? But many of you may heard of Peter Thiel. Peter Thiel in 2004, he invested in Facebook $500,000 in 2004. Fast forward to 2012, when Facebook went public, he cashed out, and overall he cashed out with $1 billion. $1 billion. In 8 years, he's seen over 1,000% return on his money just within 8 years. I don't know about you, but I can wait 8 years to make $1 billion by investing in $100,000, right? So some of you might be on here and say, hey, I don't have, that type of money to see a great return, which is true. But there's other opportunities that's out there where we can see a high percent return on our money. So let's talk about the good old boys. The venture capital space, which we just went over in the US, and primarily when you hear the companies like Facebook, Uber, Postmates, Amazon, like when you hear these companies that goes public, a lot of these companies come from Silicon Valley. Silicon Valley is like the Harvard of college, the Wharton in college, right? So if you have this great idea, this great product or service that you're looking to launch, Silicon Valley is the way to go because of their connections and their network and their resources. And wherever you at in the United States, if you have to go to Silicon Valley, guess what? You have to pack your bags and you got to go up there to Silicon Valley, right? But the problem is this, especially in the Black and African American communities, Silicon Valley is occupied mainly by white males, right? So when you look at the investment teams, African Americans only take up 1.5% of the team of when you're talking about Silicon Valley or any VC firm that has some form of credibility or capital to invest in startups. And for years, that have always been an issue because when you have creative Black founders and Black entrepreneurs that's looking to raise capital, they don't get funded. Why? Because it's primarily obtained by white males who do business with who they know. And unfortunately, we get the short end of the stick again because now we have the lack of access to capital, lack of access to resources, lack of access to networks. Many of us don't come from a background of rich families or come from a background of entrepreneurs. So right there alone, we already behind the eight ball because we don't have the network in our radius to ask for funding. So talking about female CEOs get only 2.7% of all venture funding. And I'm talking about females from all races, right? But black women, they get 0.2%. So there's a problem in the funding space. There's an issue here when it comes to funding. We can't go to banks because we don't have the proper business model or business structure or credit or revenue to get, loans. We don't have the family, the rich mom or rich dad to help us jumpstart our business. We don't have the networks or resources to reach out to VCs and angel investors to help fund our business, right? So when you're talking about businesses failing, this is one of the reasons why businesses fail, because we don't have the proper capital and resource and network to connect us to scale and grow our company. This is why we created Crowd Wall Street. So the main initiative of Crowd Wall Street is to support the growth of African Americans, which includes developing and growing Black and minority investment communities. Our goal, which is why I'm teaching you guys today, is not only to support Black entrepreneurs and minority entrepreneurs, but also to create an investor's mindset for our people. And I always say entrepreneurship may not be a good fit for everybody, but everybody is fit to be an investor. And if we're able to position ourselves to be investors, now we'll be able to support our Black entrepreneurs and Black founders. So our goal is to help create more entrepreneurs, resulting in more successful Black-led companies who can then go to fund and help other African Americans start their own business. This is what angel investors is. Most angel investors are individuals that had businesses, successful businesses, made money, and now they're giving back and help and supporting other entrepreneurs. So if we can create the same model where we have more successful Black-owned businesses who eventually make enough money and to eventually become angel investors and give back to those who are looking and aspiring to be entrepreneurs, this is what you call group economics. And trust me, I get it. Some of you saying right now, look, I don't even have, $500 right now to support or anything like that. I got you. Just follow with me. So here we have two main streets, I would say. You have what's called Wall Street and you have what's called Main Street, right? Many of us are familiar with Wall Street. Wall Street is basically, hey, you get your TD Ameritrade account, your Ally, your Robinhood, and you invest in public stocks. You buy shares of the company. You may not ever talk to the CEO or founder. You may not ever be at a board meeting. You may not ever be at a conference call or anything. All you're doing is sitting back and watching the stock market either go up or go down, and you make your money however your strategy is, right? That's Wall Street. Then you have what's called Main Street. Main Street is your average businesses, your startups, your pea supply, your hair salons, your barbershops. When you're investing at this stage, you're like technically directly investing in these businesses. Like you're actually involved and you have the opportunity to talk to the business owner. You actually get to have conversations with the CEO. You actually get to see the business grow. And you just pretty much hands-on in so many ways, but you're kind of hands-on and you're actually investing in startups and small businesses that we may use every day, right? So those are the two different things. Primarily what we focus on here is Main Street. We're not really focused on Wall Street. And as you can see, let me go back real quick. As you can see, Wall Street is the last thing on this graph right here. So we're all investing at the stocks, but there's so much money being made at the bottom. So we celebrating like we anticipating to get on with Airbnb and DoorDash because they getting ready to go public. But at the end of the day, these people cashing out. They cashing out over thousands of dollars. But we getting excited because we getting crumbs, so to say, in so many words. We getting crumbs. Granted, you can make money in public. You have to be strategic and know what you're doing. But these people cashing out, like I said, 700 to 1,000% more than what we making. Now we have the opportunity to do the same thing. So here it is. How to become an angel investor. So like I said before, angel investors are typically successful entrepreneurs that have the knowledge, capital, wealth of experience that can be beneficial to founders. Some of you may not even fit this category and wondering like how the world I'm gonna become an angel investor. Like I don't really have the knowledge of this stuff, or I don't have much capital to invest in small businesses or startups, and I may not have enough experience to even give advice to these businesses. And don't worry, I got you. So you have what's called the Jobs Act of 2012. This is something Obama passed. He made it possible for the average person to invest in early stage startups by easing restriction on crowdfunding, which is what WallStreet is, a crowdfunding platform where you will have the opportunity to invest in startups. Is it a high risk? Most definitely is a high risk, right? But the great thing about crowdfunding is you can invest in startups with as little as $100. And with that $100, you can get a small piece of equity in a startup. And the great thing about that is imagine having a black-owned businesses that's raising capital through crowdfunding, and your little $100 to include 30 more people or 100 more people that's also contribute $100 or $1,000 for the success of that business. And guess what? You have equity in that company. So the more successful we make that company, the more successful you are as far as seeing the return of your money. Just imagine, like we talk about, McDonald's and Walmart and Amazon. You should own stocks in those companies. Why? Because 9 times out of 10, you shop at these companies. So the more this is saying you vote with your dollars, right? Wherever you spend your dollar with, that's considered voting. If I'm spending my dollar at Walmart, it's because I like Walmart. If I'm spending my dollar on Amazon, it's because I like Amazon. And the more I spend my dollar with these companies, the more successful they become. So it's always good to own stocks in companies that you shop at. It just only makes sense. So when we're talking about building generational wealth and we're talking about supporting our black businesses, this is one way we can do it. Sharing equity in our company. Just imagine somebody having a restaurant and open up a franchise. I'm in Miami, so imagine somebody open up a franchise in Miami. Let's say I have a restaurant in Atlanta, but I want to franchise out in Miami. But instead of me going to the bank to get a loan, guess what? I'm going to go through crowdfunding, and I'm going to ask the community in Miami to help raise the capital so we can open up a franchise in Miami. Guess what that does? Now that we raise capital, let's say we raise $100,000, and now we got this restaurant booming or this gas station booming in Miami. Guess what y'all gonna do? Y'all gonna continue to shop at that restaurant or continue to get gas at that gas station, because you know the more money you spend at that franchise, the higher your value of your equity gonna go up. This is what group economics really is. This is how we do it. This ain't no su and none of this stuff. This is how it goes down. This is how the big boys play. And so right now, this is what our goal as Crowd Wall Street. This is what we're creating in our community, and this is what we're trying to teach you. So again, going back to what I was saying, you don't have to have all the wealth or all the money in the world to invest in startups now. You can actually invest 100 startups, and I will always highly recommend start educating yourself, start learning about business, understand how to read financial statements, understand what it is to invest in startups, and trust me, stick around long enough with us. You know, you join our group, you join our live, we're going to educate you surely on how to be successful angel investors, VCs, private equity, you name it. We got the information for you. We're going to teach you guys how to do it. So I know a lot of this, and you know, all this talk about how to be an angel. I have 3 things for you, and of course, this is just overview. There's a lot that go in between these things, but 3 things for you. Number 1, assess your current financial situation. Of course, I would never I'm not an investor to invest your last dollar into startups. Again, this is an asset class. You have real estate, you have commodities, you have food, and you have startups. Startups, investing in small businesses is an asset class, and it's a high risk asset class because businesses. In this, when you're talking capital, most of these startups are what we call experimenting ideas, right? So you have these tech companies, these people come up with these creative ideas, right? The whole is for this money to make sure or find out if it works. So they come up with an idea, new technology or new prescription or something like that. They raise investors, believe in them, but then 2-3 years come to find out it doesn't work. That's another business that fail. So when you hear about 90% of startups fail, you have to understand that it's mom and pop shops that's failing. These companies that's raising capital make a majority of the failure of businesses. And because these startups are expanding, a new Facebook, maybe one company may do it. That's 9 businesses that fail, right? So again, assess your current financial situation. They always recommend, you know, you want to invest at least 5 to 10% of your portfolio in startups. And for those individuals who may have a little bit more money, let's say you have $5,000 to spare to invest in startups, we will always recommend to spread that $5,000 across maybe 20 companies. Don't just invest $5,000 in one company. I'm speaking primarily on crowdfunding. If you find a company you like, don't just give that company $5,000 unless that company has a promising future. Then I will always recommend, you know, $500, spread $500 across 20 different companies. And the reason I say that, because let's say you invest in 20 companies, right? 19 companies may fail, but that one company may do wonders, right? And you're going to make 30 to 40 to 500% return on your money, which is going to make up for the 19 companies that fail, hands down. So it's not a matter of worrying about which business is going to fail. It's a matter of which business is going to succeed. Because as I showed you with Peter Thiel with Facebook wasn't the only investment that Peter Thiel made, but Facebook was one of the companies that end up going up the chain and going public that made him a billionaire, right? So we have the same opportunity, right? So the second thing, what type of businesses interest you or have expertise in? Warren Buffett said, never invest in something you don't understand. Um, and that's key. You know, if you're in an industry that you understand, that's better for you, and that helps you do your due diligence to know what type of company you can invest in. Or if you have an expertise in a particular industry or sector, those are the type of companies you want to start at because you have some type of background and understanding how to invest in these companies. You don't want to put your money behind something you can't even explain. It really doesn't make sense, right? The third thing, learn how to be an investment detective, meaning learn how to do your due diligence. And I'm going to do a whole training on that. How to do your due diligence, how to research companies, how to read financial statements, what are the things to look for, understanding the terminologies, understanding all that stuff. You have to become an investment detective the same way we do with real estate, the same thing we do with buying stocks, the same thing goes on when you're investing in startups, right? So I know some of you saying, hey, you know, I don't have that much money to invest. Here's some options. Number one, like I said, you can invest in these startups and as little as $100 and get a small equity ownership. And granted, you may not make it to a billionaire, but you're going to see, it's going to give you the experience. I would say that it would give you the experience on how to invest. Now take it, you can take that $100 and times it by 10, right? So you can invest $100 in 10 different companies. Now you have maximized your chances of a high return, and then you hedge your risk. So now I can take $100 and invest in this company, invest in that company, invest in that company, right? Maybe you have $5,000. Like I said before, you may have $5,000 to go ahead and invest in this asset class, right? Again, I will always recommend you don't want to invest $5,000 into one company because again, these companies can fail. So instead of you investing $5,000 into one company, you could take that $5,000 and disperse it to 20 to 30 different companies. Now you have a portfolio of 20 to 30 companies. Guess what? That increase your knowledge and understanding on how to invest in companies. That increase your portfolio, your diversification, diversifying your portfolio. And like I said, out of 20 to 30 companies, you only need one company. Hear me out. Out of 20 to 30 companies, you only need one. You need one company to either get brought out or go public. And I know you guys see it all the time. Big companies buying small companies, or this company like Airbnb and DoorDash getting ready to go public. Just imagine you have a group of people that's waiting for this company to go public to buy shares. Then you have another group of people that's waiting for this company to go public to sell it, right? So when you buying shares, you actually buying people out who's making millions of dollars. It's crazy. So we're excited to get in, but these people are excited to get out. And I'm gonna explain how all this works when it comes to having funds, when it comes to VCs and how they operate. I'm gonna give y'all the game. And that's gonna be another trainer, but I'm gonna give y'all the game. And we can do it. The thing is, we can do the same thing, right? So you may not have $100, you may do. You may not have $5,000, but you may do. Here's where the kicker is at. You can get a group of individuals, and I'm just using $500 as an example. Everybody can contribute and create a fund where you can put $500 each. You get 10 individuals, $500 each. We have $5,000 together, right? Now we created a fund. Now we can find different startups to invest in. Now we can invest in 20 to 30 companies across the board. What that does is that helps hedge risk. Everybody's sharing the risk. Now we able to see a higher return on our money. Now you're talking about, now we're really digging deep into group economics. And granted, this don't even have to be for startups. You can do this for real estate. And I know it's difficult for people to trust each other, whatever, but if you want to go far, you got to go together. So these are different options you have when you're talking about investing. You know, you can create a fund where people, a group of people can contribute money, and create a $5,000, $10,000, $20,000 fund, and you can become an angel investment group, and you can be that fund to help startups, to help birth somebody's great idea, through crowdfunding or even doing it individually. So these are the options that you have. And I told you I won't be long. Quick, straight to the point. Again, if you're not watching this from our Facebook group, you watching it on my Facebook page or YouTube, join our Facebook group. This is like one of the many trainings. Like, I just went real basic with with you all. I went real basic, right? But every Sunday I'm gonna start giving you the game, because let me stop sharing this so y'all guys can, so I can show my face. Right. So listen, this is why we built Crowd Wall Street, right? Because we getting ready to change the game. This is an opportunity that our people, especially Black people, didn't have the opportunity to get into this type of space, right? And statistics show, numbers don't lie. When it comes to raising capital, it's very difficult for us to raise capital in this space. Just a quick understanding of how this space works when it comes to investing, especially when you're dealing with angel investors and venture capital firms and things of that nature. Because I spoke to a young lady and she was inquiring about a VC. She wanted a VC investor. This space is not, and I'm speaking for entrepreneurs. For entrepreneurs, this space is not for everybody. Why? Because when you're collecting investments from angel investors or VCs, primarily VCs or private equity or hedge funds, when you hear, and I see this on Facebook, and right now you see a lot of these posts going around where, or what's the Sierra, I think it's Sierra and her husband created a fund, or Beyonce created a fund, and this person created a fund, or this person created a $10 million fund, this person created a $20 million fund. And then I see people saying, oh, I need to apply, I need to do this. Listen, those people don't have the money in the fund. Not saying they don't have it personally, but when you hear somebody's creating have a $10 million fund, doesn't mean they have $10 million. And this is gonna be another training, but I'm just giving y'all the nugget right now. When you hear somebody saying they have a $10 million fund, 9 times out of 10, they don't have $10 million in their fund. These VCs have to raise $10 million. So the fund is set at 10 million, but they have to raise that 10 million from other investors, from wealthy investors, right? So just give you as an example, I'm a VC. I'm looking to raise a $10 million fund, right? I don't have $10 million in my fund, but I have what's called an investment thesis. I want to invest in fintech. I want to invest in medical devices. I want to invest in consumer products. I have my own business plan. I have it all laid out, right? So what I have to do, I have to raise money myself. So I have to go find wealthy investors to contribute to my fund. So when they contribute to my fund, let's say I end up raising $10 million, guess what? Out of that $10 million, I have to get paid out of that. So I get paid 2% out of that 10 million. And that's my yearly salary. Y'all ain't catch that. You have the opportunity to create a fund, raise money, and get paid to manage people money, right? This what goes on with this, how the big boys play. So the key I'm getting at is, as an entrepreneur, when you're looking for funding, especially in the VC space, understand that 2 things have to happen. Number 1, your company has to go public. Number 2, you have to have or be acquired by another company, right? Those are the 2 main things. You can do revenue share, but many companies are not, many investors are not going that route. Why? Because again, like I just explained to you, I'm a VC, but I have other people's money. And these investors who invested in my fund, they're looking for a return on their investment. So I can't do revenue share with you because I got people I got to pay. So that's why Many VCs invest in high growth companies. These companies that's scalable. These companies that's going to at least minimum 2x, 3x multiple revenues, and they have to have an exit strategy. And I did a video last week about exit strategy. If you missed it, catch it on YouTube. So that's why, for example, when we talk about Facebook and Peter Thiel had an investment fund. He raised capital from individuals. He invested in Facebook. 2012, Facebook went public. Peter Thiel cashed out, became a billionaire. So when we're talking about investing in startups, we have the same opportunity now. We can do it individually. We can do it as a group. But now this is what goes on. And we're not going to even get into mergers and acquisitions. We're going to be talking about that, right? So that's angel investors. Angel investors are individuals that invest in startups and early stage companies. You can get it in equity or convertible note, which I explained previously in a video. And this is what we're building. This is what our platform is built out to be. WallStreet is a crowdfunding platform. We're going to have opportunities for entrepreneurs to raise capital for their business from the crowd. And we're going to have opportunities for investors to invest in these startups. So we won't only have startup opportunities, we'll also have real estate opportunities as well. So the real estate portion, real quick, is just individual who's into project developments, looking to, build apartments, build houses, whatever. Now, they can actually come on crowdfunding, come on WallStreet and raise that money. And when we talk about group economics, if I'm building an apartment complex and I raise $100,000 for the down payment to get the infrastructure built out, guess what? Everybody who helped contribute at that level will have equity ownership of this apartment complex. So now when the apartment complex start generating revenue, everybody eating. Everybody's making money. Now we talking about ownership. Now we talking about equity. Now we talking about group economics on a whole nother level. And I'm not going to get started with what we getting ready to do in Africa. Now you're getting to spread your money all the way out and get some rands. So I ain't for to sit here and rant, but again, this is just one of the beginning trainings helping you guys understand what an angel investor is. I shared a little bit what a VC is, but next week, Sunday, I'm going to do another training and I'm going to teach you guys what a VC is. And I'm going to even teach you guys how to start your own fund, because you can do it. You can start your own fund and do the same thing that our counterparts are doing. Only thing that's lacking is the education. And like I said before, it's our job to educate you. No crowdfunding platform is doing what we're doing. No crowdfunding platform is getting ready to do, is doing what we getting ready to do on a whole nother level. So I hope you learned something. I hope you enjoyed yourself. Go ahead and share this video. If you miss it, it'll be on YouTube. Give me some thumbs up. If you have any questions, put in the comments. Me or one of my teams get back to you. Appreciate you. See you this Wednesday for Wall Street Entrepreneur. And you guys be safe out there. Wear your mask.